Okay, let's look at the data. We've all seen the headlines, right? The crazy charts, the explosion of talk on social media. But underneath all that hype, there's a massive conflict playing out in the market. So today, we're going to decode the data behind the meme stock anomaly and really get into the divergence between what retail is saying and what the institutions are actually doing. And this comment right here from a user on Reddit, it just perfectly captures the problem for so many traders. There's this real hunger to understand how the market actually works, to see where the big money is going. But there's a ton of confusion about where to even find that data, let alone how to make sense of it. And that information gap, that's exactly what we're going to bridge today.
So here's the crucial divergence. On one side, you've got this incredibly powerful retail narrative. It's a real movement, fueled by entire communities with these rallying cries like "to the moon" and "diamond hands." But on the flip side, the institutional players, well, they often see this huge wave of buying not as a revolution, but as a golden opportunity. It's what the pros call exit liquidity.
To really get our heads around this, let's dive into a specific case study. OpenDoor Technologies, ticker symbol OPEN. This company became the absolute poster child for the 2025 meme stock resurgence, and its story has every single key ingredient of this whole phenomenon. I mean, just look at the sheer velocity of this move. In a single month, July of 2025, OpenDoor stock just exploded, up over 500%. Now, keep in mind, this was a company that was basically on the ropes. They were even thinking about a reverse split just to avoid getting delisted. And then, bam! A tidal wave of retail buying changes the entire game, creating this massive repricing event based almost entirely on sentiment. And that brings us right back to that key term, exit liquidity. See, when thousands and thousands of retail orders hit the market all at once, it creates incredibly deep and active trading. So for an insider or a big fund that needs to sell millions of shares without completely tanking the price, all that retail enthusiasm is the perfect off-ramp. The crowd literally provides the volume for the smart money to quietly slip out the back door. Okay, so we've seen what happens, but how? How does it happen? Let's actually break down the mechanics here, the data-driven formula behind these insane moves, because it's not random. It's a predictable, even if it is a chaotic, process. It pretty much unfolds in 3 steps. First, you need what I call a coiled spring, a stock with ridiculously high short interest. Think of a company like Kohl's, which had nearly 50% of its shares sold short before it went parabolic. Second, you need the catalyst. That's the coordinated surge in retail buying, usually organized on social media. This pushes the price up, and that forces the shorts, the people who bet the price would go down, to buy back shares to cover their massive losses. And that forced buying is the squeeze. It just creates this feedback loop that sends the stock into orbit. So what are the actual data signals analysts are tracking? Well, with OpenDoor, the short interest was sitting around 21% of the float. That's the total number of shares available for the public to trade. And look, anything over 20% is considered extremely high. It basically paints a target on the stock's back. At the exact same time, quantitative analysis of platforms like Reddit showed this massive spike in comment volume and, this is the key, in positive sentiment. Using AI models that can actually read and understand the emotional tone of text, you can literally quantify the hype and watch the catalyst build in real time. Okay, now, while retail is laser-focused on the squeeze, the institutions, they're focused on their exit. The absolute key here is to track what they're doing, not what they're saying. And to do that, you have to follow the paper trail they are legally required to leave behind. So let's dig into that. This comment about Carvana from a user on Wall Street Bets, man, it just says it all. It's blunt, but it is spot on. The very moment that company got added to the S&P 500, which forces index funds to buy their stock, insiders sold. It's just a raw reminder that in this market, your buying can very easily be someone else's selling. So how do you track this stuff? It's all out in the open, in public SEC filings. Think of them as the market's required reading. The 10K, that's the big annual report. The 10Q is like a quarterly pulse check. But for tracking the big money, the absolute holy grail is the Form 13F. Any manager with over $100 million in assets has to report their holdings every quarter. This is the single best tool we have for seeing the footprints of institutional capital. But, and this is a huge but, here comes the major plot twist in this entire story. Just as retail investors are getting smarter, getting more sophisticated, and demanding more data, the regulatory environment is threatening to go in the complete opposite direction.
A major conflict is brewing, and it's a big one.
And I'm not being dramatic here. This isn't some minor rule change. We could literally be heading for a data blackout that would completely change the game for anyone trying to track these big institutional flows. It would make the market so much more opaque. So here's the proposal. The SEC wants to raise that 130F reporting threshold from the current $100 million in assets to, get this, a staggering $3.5 billion. That is not an adjustment for inflation, my friends. That is a quantum leap that would just yank thousands of managers out of the public eye. How many? Well, according to the SEC's own analysis, we're talking about an estimated 4,500 institutional investment managers. That's nearly 90% of everyone who currently files. They would no longer have to report their holdings. Their positions would just go dark, hidden from you and me. And what's really crucial to understand here is that the system we have now is already flawed. As this comment letter to the SEC points out, 13Fs don't even capture derivative positions, like options or swaps. The whole collapse of Archegos Capital was a direct result of this exact blind spot. They built these enormous leveraged positions using swaps that were totally invisible to the market, right up until they blew up. This new rule would make that blind spot astronomically bigger. So let's put all the pieces together. What's the strategic outlook for a retail trader in this environment? I mean, how are you supposed to navigate a market that's driven by social media on one hand, but is about to become way more opaque on the other? Well, there are really two ways you can look at this. The bull case is that all this volatility creates incredible opportunity for nimble, data-driven traders who really understand the signals and the mechanics of a squeeze. The bear case, though, is that as this institutional data gets harder and harder to find, the information gap just gets wider. You could be providing the exit liquidity for some huge fund and not even have the tools to know it. That just ramps up the risk dramatically. Which leaves us with this final question to think about. In a market with these growing blind spots where the biggest players on the field can shield their moves from view, who truly has the information and the capital to weather the storm? As the data gets scarcer, who's really holding the diamond hands? We are tracking these institutional flows in real time. While you analyze the next move, check out the tools in the description. You can sign up for Public to get $20 in free assets, check out Webull for that BTC promo, or look into NVIDIA on Mumu. All the links are down below. And hey, do us a favor and like and subscribe for more of this deep dive analysis. And of course, the reminder, this analysis is for educational purposes only. It's based on current data, and that data changes fast, so please always do your own due diligence.
Stay disciplined, stay liquid.